Live from Sydney, this is Insight with me, Paul Allen, where we dive deeper into the stories that matter with crucial context and sharp analysis. Let's start with China's retail sales posting a surprise slowdown in November, rising just 3% on year, and that was well below economists' forecasts. It's highlighting the urgency for Beijing to find ways to get people spending. South Korea's currency and stocks little change today after President Yoon's impeachment, suggesting investors are worried the turmoil is not yet over. We'll be live in Seoul with the latest. Plus, we'll wrap up the economic and geopolitical fallout with Nomura and the Chicago Council on Global Affairs. Also, India's richest man dropping out of the elite $100 billion club, their fortunes being eroded by threats including underperforming businesses and allegations of wrongdoing. Well, we've got Chinese stocks falling after retail sales growth surprisingly weakened in November, indicating that the effect of recent stimulus measures might already be wearing off. Industrial output, meanwhile, did edge higher to meet expectations of 5.4% growth. Retail sales, though, they only added 3% from a year ago, and that's the slowest growth in 3 months and significantly weaker than the median forecast of 5% in a Bloomberg survey of economists. Now, boosting consumption's become a top priority for Chinese policymakers due to the threats of a new trade war with the US as Donald Trump returns to office. And that may diminish Chinese exports' role as a growth driver after contributing nearly a quarter of economic expansion this year. So with that in mind, let's get to our first guest. Sonal Varma is Chief Economist for India and Asia, excluding Japan, at Nomura. She joins us live today from Singapore. Sonal, thanks so much for joining us. I want to start with those retail sales figures out of China, a pretty significant miss. And coming just on the heels of the work conference where they vowed to lift consumption vigorously. Obviously, consumer confidence here goes hand in hand with what's going on in the property market. Have moves to stabilise the property market and promote consumption been enough, or do you think we're going to need to see a lot more here?
Well, the numbers clearly show we need a lot more going forward. Encouragingly, we did see the right notes coming out both from the Politburo as well as the Central Economic Work Conference last week, looking to put prioritizing domestic demand, more proactive fiscal policy, more on monetary policy. So all the right notes, but we do think that the current down cycle in China is not a normal down cycle, which will get averted because of bazooka stimulus measures. So the ongoing property down cycle, the geopolitical tensions, the pressure on local government fiscal finances. So a lot more needs to be done in our view. For now, we still see growth risks as skewed to the downside as we look out to 2025.
So in terms of more policy support for consumers, we're not getting a huge amount of detail from China at the moment. What specifically would you like to see? I've heard some talk of vouchers, of discounts for consumers. Are there any specifics that, in your view, might do something to get consumers spending again and feeling confident?
Yeah, there are multiple pillars that can be implemented to support consumer spending. One is stabilizing income and increasing disposable income, particularly for low-income households. So increased pension payments, more support on medical care. For instance, cash voucher is an option as well. But the second important pillar is also stabilizing property markets because that's where a lot of the household wealth is actually stored. And the negative wealth effect, in our view, is also weighing on consumption. So a lot more needs to be done in terms of delivering the pre-sold but still unfinished property in China going forward. And third pillar is really stabilizing growth and looking for new growth drivers, because consumer demand at the end of the day, consumer confidence, it actually boils down to having visibility on jobs and income prospects going forward. So it needs to be a combination of all three in our view.
Well, let's talk a little about the industrial production numbers as well. They met expectations, a moderate beat, in fact, but considering the overcapacity in China at the moment, is higher industrial production really what the country needs?
Right now, actually, it needs to move to really accelerate domestic demand because the current support we are seeing on industrial production is partly reflecting, in our view, the front loading of exports that we are seeing right now. And 2024, in general, has been a year where exports have actually been a big support to China's growth, whereas domestic demand has been soft. Now, into 2025, as we are expecting, fast implementation of Trump tariffs on China, exports, we think, will be a drag on growth. We are looking for export growth to, in fact, slow to closer to 0% next year. And therefore, really accelerating domestic demand is going to be a lot more important. The other big challenge in our view next year will be for the rest of the region. China, if it's not able to export to the US, we do see a risk that these exports will get redirected to rest of the world, rest of Asia, and therefore China's overcapacity actually leading to more disinflation as a bigger challenge for the rest of the world is a major risk.
Let's talk a little bit about the trade situation as well. Of course, President Trump will be inaugurated next month, and one imagines we'll see tariffs imposed fairly swiftly after that. What's the path around this for China? How do they negotiate their way through this? And do we potentially see China buying more US products?
Well, it really depends on what exactly we see under Trump tariffs. I think, already with the initial post that we've seen on Truth Social, it looks like, as you said, tariffs will be implemented fairly quickly. And that's indeed our view. We think, unlike the first Trump presidency, where the tariff implementation took almost a year, we think this time around it's going to be pretty fast. For China, therefore, I think, the risk is, how does China retaliate? And we do think there's a risk of more tit-for-tat retaliation coming through. We've seen some export controls already come in on rare earth exports. We think China could also partly weaken the currency in retaliation. I mean, there could be a deal in terms of China buying more of US products, but things are still quite uncertain. And from our perspective, we think the basic assumption is that exports and trade will be a major growth drag for China and also for Asia more broadly, given the trade tensions which look likely to stay.
Yeah, you mentioned the currency there. China's certainly signaled a willingness to potentially let it weaken further in 2025. What's your floor for the yuan? Where do you see it heading?
Well, our team is looking for dollar CNH at 7.6 by middle of 2025. Now, a weaker yuan, we do think is a double-edged sword. It can offset the impact of higher tariffs. At the same time, China needs to ensure that any weakening does not trigger a loss in confidence or triggers more capital outflows. So it's going to be a delicate balancing act. But on net, we think this is going to be one of the tools to offset higher tariffs that are coming through next year.
Do you see any Asian economies that could potentially gain from US-China trade tension?
Yes, we do think some Asian countries like India and parts of Southeast Asia could benefit both from trade diversion as well as the supply chain relocation theme. The work we've done shows that India and Malaysia in particular are already benefiting and likely to benefit more from US-China tensions. The one thing that we think that's different under Trump 2.0 is that there will be increased scrutiny on some of the third countries that are being used to bypass tariffs. And on that, Vietnam does stand out as one potential country where there could be greater scrutiny this time around. But for India and Malaysia, we do think they should benefit.
All right, Sonal Varma is staying with us. Sonal is Chief Economist, India and Asia ex-Japan at Nomura. Still to come this hour, we're going to take a closer look at opportunities as well across Asian private credit markets with Moody's co-head of global bank ratings, Sally Yim. First, though, Karl Friedhoff of the Chicago Council on Global Affairs will join us as we dive into the political turmoil in South Korea. This is Bloomberg. Yoon Suk-yeol he's quickly joined the long list of South Korean presidents who have faced impeachment, imprisonment, or both. On Saturday, Korea's parliament voted to oust Yoon from office, a decision that must now be reviewed by the Constitutional Court. Opposition leader Lee Jae-myung has emerged as the most likely to take Yoon's office, but he has some legal hurdles to cross before he can run in fresh elections. Bloomberg's Asia Trade co-anchor Sherry An joins us now from Seoul. So, Sherry, what happens next after the impeachment?
So now that we have the impeachment bill passing Congress with 204 votes, with the opposition garnering more support from the ruling party, we are seeing this now go through the Constitutional Court. It can take up to 180 days for the Constitutional Court to either uphold or vote down the impeachment bill. Usually it's taken less than half of that time. As you said, we've had experience with impeachments before. This is the third president now that is going to go through impeachment proceedings. Now, the key question coming into this stage was whether or not the Constitutional Court would be able to vote at all, given that we have seen, of course, vacancies in the court. Political parties in South Korea now saying that they're seeking to fill those vacancies. There are 3 at the moment. If that impeachment bill is upheld in court, then we could see presidential elections triggered within 60 days. Now, the political crisis here in South Korea might not be anything new, but we have seen that markets have reacted. We have seen protests as well. Even today, which is a relatively more calm day here in Gwanghwamun, central Seoul, we had earlier protesters just behind me rallying, demanding that President Yoon be removed, and also that the next administration bring in more progressive ideals, especially when it comes to women policies.
Well, in terms of markets, the Kospi seems to be back to where it was before all of this drama began. There seems to be a floor under the Korean won as well. What sorts of things are being said to reassure markets?
We have seen South Korean officials very proactive throughout this process, coming out and talking about stabilizing the markets. We had the Bank of Korea already releasing a statement over the weekend, pledging any support necessary to keep the economy afloat. We had seen a lot of that impeachment already priced into the market. So we saw an initial reaction at the open today. Stocks were higher. The Korean won was supported, but a lot of those gains have now petered out. As you can see, the Kospi is barely moving, and the Korean won right now under pressure against the U.S. dollar. Still, as you said, we're back to levels seen before martial law declaration. And some economists, for example, from BNY analysts now calling that potentially we could see more upside for the Korean won going into year end. But a lot will depend, of course, on the prospects broadly for the Korean economy as well, because people are worried that the political problems here in South Korea will not help confidence and the consumption could take a hit.
All right, Bloomberg's Asia Trade co-anchor Sherry An there in Seoul. Well, Nomura's Sonal Varma is still with us. We're also joined by Karl Friedhoff, Asia Studies Fellow with the Chicago Council on Global Affairs. And Karl, I want to start with you. Sherry was outlining some of the what happens next following the impeachment of President Yoon. So he's been summoned now by the probe team to answer some questions. That's happening at 10 o'clock on Wednesday morning. So what happens next here? What will the fate of President Yoon be, and how much of a guide is history here?
So the next step is really going to be what happens after that investigation takes place and indeed his interview takes place. The question will be is if they intend to arrest him on on charges of whether it's sedition or whether it's treason or whether it's internal rebellion. To me, the charges aren't quite clear, as well as who's actually doing the investigation, whether it's the prosecutors, whether it's one of the police investigations as well. In terms of history being a guide here, on the timeline we just heard previously, and that timeline sounds just about right. The Constitutional Court is already reviewing the case. I think they intend to move quickly. There's some speculation about why they're trying to move quickly, but they are going to move quickly, and I think try to rule within the next 2 to 3 months, which if the impeachment is upheld, then yes, we would see a potential new presidential election held in late April, May, or potentially early June.
In terms of the Constitutional Court, though, there's a problem there as well. There's 3 vacant seats right now. How quickly can they be filled, and how quickly can they move? Can their desire match reality?
So the progressives have said that they intend to fill those seats by the end of the year. Given their overwhelming majority there, I expect that they'll get the bill through. Those appointments will then be taken to the desk of Han Duck-soo, the prime minister and now acting president. Whether or not he will approve them or not, I think is up to debate, but I suspect that he will. At this point, the Korean public has spoken that it wants and spoken on which way it wants this to go. So I don't think that there will be that much pushback on that. Once the seats are filled within the Supreme Court, then of course they'll get down to the more serious business of reviewing the case and then offering a ruling.
Sonal, I want to turn to you about some of the economic impact of all of this. As Sherry-Ann mentioned a moment ago, the Kospi's back to pretty much where it was before martial law was briefly declared earlier this month. We've heard some soothing remarks from the Korea Exchange, from the Bank of Korea as well. To what degree have markets been protected, and can they remain protected from the political turmoil?
Signpost to look out for in Korea, but our view is the political uncertainty is still not completely behind us. So the entire process of Constitutional Court, and then if we have fresh elections, basically means that sometime in late second quarter is when things will settle down. So that leaves the economy with 4 to 6 months of elevated uncertainty. Which, if you look at the past impeachment episodes, tends to weigh fairly significantly on consumer sentiment and also on, therefore, on consumer discretionary demand. So we do expect consumption demand in Korea to soften. In fact, we've cut our 2024 GDP growth projection to 2.1% from 2.2%. And, a lot of this is happening at a very bad timing, actually, because the export cycle itself is slowing down. Some of the low-end memory prices are cooling down. Trump tariffs are coming up. And so the combined impact of this, we think, means that 2025 in general is also going to be a year of below trend growth. So we are below consensus, looking at a 1.7% GDP growth. So a mix of weak domestic demand and weak exports.
Yeah, and how does this play into your views around Bank of Korea policy in 2025 as well? I know you see some easing. Can you tell us about the magnitude and the timing of what you're expecting?
Yeah, sure. I think this macro uncertainty and weak domestic demand clearly means that both fiscal and monetary policies are actually going to be more expansionary. For the Bank of Korea, we are expecting another 75 basis point in rate cuts by end of 2025, so a terminal rate of 2.25%. The next meeting of the BOK is actually in January. However, that's just ahead of Trump's 20th Jan inauguration, and we could see increased FX volatility. So very near term, we think that's a bit of a constraint for the BOK. So we expect the next cut to come through in February. But the risk is BOK might have to do more. And also, we think fiscal policies will be more expansionary. The implementation of this could be in the second half of 2025. But that will also need to pitch in to try to stabilize domestic demand.
Karl, I want to bring it back to you in terms of a potential successor for President Yoon. I mean, this does open the door for the opposition leader, Lee, but he's got problems as well. He's got a suspended jail sentence for breaking electoral law. Is he going to be the next president, or is it going to be somebody else?
Come down and are kind of upheld on appeal, and then he's eliminated. If the election happens before that, I fully expect that Lee Jae-myung will be the next president of South Korea. But I also want to go back a little bit and look at the previous election, and the reason that we got to these two candidates, which was President Yoon, a now impeached President Yoon, and Lee Jae-myung also ran in the previous election. And the reality is that on both sides of the aisle, their bench is not very deep. There are not very good candidates on either side, which is why these two people ended up running for president. If Yoon is out of the picture, the Conservative Party doesn't really have anyone else to step into a leadership role. And if Lee Jae-myung is out of the picture, the progressives don't have anyone to step into a leadership role, which is exactly why the Conservative Party is trying to delay this process as much as possible to try to eliminate Lee Jae-myung from the picture. But as I said, if we move to elections within the next 3 to 4 months, Lee Jae-myung is clearly favored in all of the public opinion polling that is out there, and he should win quite handily in an election.
So South Korea is a relatively young democracy, but its history's somewhat patchy as well. We've got only three of the last 8 democratically elected presidents have not been impeached or jailed. Does this speak to a broader problem in Korean politics? Is some sort of reform needed? What's going on?
There's really any necessarily need for reform on this piece of it. They are caught up in somewhat of a revenge cycle of politics, but also there has been a lot of wrongdoing by previous presidents. And now let's not forget that. Then this is a place where when there is wrongdoing by presidents, it's not overlooked. It's not swept under the rug. It's not then they're reelected to office to serve another 5-year term. That's not an option in Korea anyway. But there is a real history of holding leaders to account, and I think that grows out of their experience with dictatorship. They overthrew the dictatorship in the late 1980s, and within the living memory of almost all Koreans is the history of accountability. And that's something that they take seriously, and I think they should be applauded for that.
All right, Sonal, I just have one last question for you, just briefly, regarding the currency. The Korean won, do you feel like there is a floor under it now, or are there still some risk factors which could drive it lower?
Well, we think risks are still prevalent, so we still expect a stronger dollar. The prospect of potentially a weaker yuan next year, plus this political uncertainty, weaker macro backdrop, POK cutting more than the Fed, a combination of all these factors, we think will still put pressure on the currency. So we are looking at dollar Korean won at 1,500 by middle of 2025.
All right, Sonal Varma, Chief Economist, India and Asia ex-Japan at Nomura. Karl Friedhoff, Chicago Counsel on Global Affairs and Fellow for Asian Studies. Thank you both for joining us so much. Still to come, we're going to get the latest outlook for Asia's private credit markets. Moody's co-head of global bank ratings is going to be joining us. That conversation up next. This is Bloomberg. Welcome back. You're watching Insight. Let's recap the numbers of the moment. That will be the China data that we had out earlier. Industrial production, let's start with the good news. That came in line with estimates, 5.4% in the month of November on year. Retail sales, however, well, that was a different story. We only had a 3% gain there. The market was expecting a 5% increase in the month of November on year. So retail sales falling far short. And the timing was unfortunate as well, because it was just a few days ago that we heard from the work conference in China pledging to lift consumption vigorously. Well, that underscores the magnitude of that task. The retail sales number undershooting there quite dramatically. So plenty of work ahead for policymakers there. Let's take a look at how Chinese assets are faring. A bit of a mixed bag, really. The Shanghai Composite is actually in positive territory by about 1/10%, but the CSI 300 off by 1/3%. We're seeing Hong Kong stocks also softer, off by almost 0.5%. The yuan there at 7.28. It'll be interesting to see how that tracks in 2025 as well, as China deals with the realities of a very trade-focused Trump administration. Well, let's get a little bit more on the markets now with Bloomberg MLive strategist Mary Nicola. Mary, thanks so much for joining us. I want to start with those China numbers, the industrial production in line. So let's talk about the retail sales, which weren't. How's this plan going to lift consumption vigorously? What more needs to be done?
Yeah, that's a great point, because at the same time, we do need a strong signal from policymakers that there is more to come. They did say that they were going to see something in terms of raising consumption vigorously. Obviously, that is a key priority, and these numbers highlight it because, of course, we saw that we got a nice boost after the September announcements, but obviously that didn't last, and so now the markets are looking for something more. The Economic Work Conference was quite disappointing in the fact that it didn't lay out any clear plans and concrete plans, so the market, frankly, is just uninspired by a lot of these broad brush statements, and that's why you're seeing that the stock markets are tumbling as a result of some of these data points.
Well, the stock market in Korea, meanwhile, really shrugging off a lot of this political turmoil. Have some of the commentary from the Korea Exchange, from the Bank of Korea as well, done enough to soothe nerves there?
Yeah, that's one thing that has been absolutely clear is throughout this whole crisis and this political instability is we've gotten reinforcements from the Ministry of Finance, from the Bank of Korea, from loads of policymakers in terms of ensuring market stability. And that's been absolutely crucial. Sure that we've seen the weakness in the Korean won as a result of the political upset. And then, of course, what's happening in Korean stocks. But the fact that they have reaffirmed their commitment to stand by these markets has been absolutely critical. There could be some reprieve in terms of the impeachment, but there's still a lot of uncertainty still to come that could weigh on Korean assets.
Well, we're getting the Fed's, well, a number of central bank meetings this week, but the key one will be the Federal Reserve. We're anticipating another 25 basis points there. But the Bloomberg question of the day is an interesting one. To what degree are traders pricing in no cuts for 2025? The path ahead's not quite as clear, is it?
No, it's not. And it's been, and the fact that we have fiscal policy now in the mix. So before it was a matter of data dependency, and that already had muddied the waters because the focus was on inflation and the labor market data. And of course, we get overreaction from every swing, from every data release that comes through on both of these numbers. And then now throw in the mix of fiscal policy and potential trade policy as well. So the outlook for the Fed becomes unclear. The markets are roughly pricing in about 2 for next year, but of course, if I would expect them to cut this week. But then the outlook thereafter is a lot more unclear and a lot more unsettling for investors and for traders, and that could again, once again, push back the uncertainty and push back how much rate cuts are priced in for next year, shifting it even to zero if they become even more cautious because of the outlook for fiscal policy.
Yeah, definitely a central bank frenzy heading into the one of the final weeks of the year. We've got Indonesia, Thailand, Taiwan, Philippines, Bank of England, even the China loan prime rate is due on Friday. But let's talk about the Bank of Japan coming up as well. Not anticipating any change this time, but when's the next hike going to be?
Yeah, that's going to be the key thing that everyone's going to be looking for, is what the BOJ guides us in terms of telling us where normalization and the path for normalization continues. The markets are pricing in some chance of a cut in January, but that's going to be really reaffirmed by the Bank of Japan. So a lot of the news that we've heard over the past week has been moving away from the direction that they could take and moving more towards the direction of that they will take their time in terms of policy, and of course what's happening politically is adding to that uncertainty. But clearly what we've seen from a lot of the data in terms of the Tankin survey, in terms of CPI, that they can move more towards the path of normalization. But because a lot of traders have been disappointed in the past by the BOJ, they just want something clear and a clear indication of what the Bank of Japan plans to do in terms of really getting the yen up, because otherwise the yen is just going to remain lackluster without any support, and especially compounded by the fact that you could get the Fed taking on a more cautious approach, bringing the rate differentials back into play, and potentially carry trades back into play, especially if the BOJ is willing to wait on the sidelines for a little bit longer.
All right, Bloomberg MLive strategist Mary Nicola there. Let's get to our next guest. Sally Yim is MD and co-head of Global Banks Ratings at Moody's, here to talk to us about private credit. Sally, thanks so much for joining us. I do want to start in South Korea if I can. And can you tell us how the risk profile of South Korea is looking to you at the moment? Because markets really seem to be shrugging off this political turmoil.
Yeah, certainly for Korea, the president has been impeached, and the election will be held in the next 60 days. So, if the political turmoil will remain prolonged, that could have an impact on the policy making as well as on the economic policies and the confidence on the economy, which could affect growth as well. So it's something that we're watching very closely. But so far, of course, the impeachment of the president, would be would have stabilized some of the question marks again the presidency, and certainly something that we would watch for the next steps as to how the situation would unfold.
So where are you seeing opportunities for private credit in South Korea at the moment?
Yeah, opportunities for private credit in Korea has been driven by lending to some of the riskier areas, such as real estate and project finance, where the banks have been shying away from providing lending. These two sectors have suffered because of lower property prices, as well as construction sectors, which has been facing high inflation and interest rates. Korea also have good, the technology sector has been very strong, such as the manufacturing of batteries, as well as semiconductors, which provide long-term investment opportunities for investors, including the private equity and private debt investors. A few years ago, there had been a regulatory change in the Financial Investment Services and Capital Markets Act, where the private equity and hedge funds are now able to make loans. So we have seen the growth of private credit quite strongly in Korea in the last couple of years. And finally, for the Korean pension funds as well as the sovereign wealth funds, they have been stated their explicit interest in terms of increasing the private debt investments.
So I want to talk a little bit about China as well, because we just had those numbers out for industrial production, retail sales, industrial production in line with estimates, but retail sales once again disappointing. What's your reaction to this? Do you think we're seeing enough from policymakers there to support consumers?
Yeah, I mean, one of the things that for China in terms of growth, I think consumer sentiment remains weak, and we haven't seen substantive policies in terms of supporting consumer sentiment at this stage. So far, the policies that have been announced have been on more of the local government debt swap, which certainly we see as positive. But in order for the growth to stabilize, we think that stimulating consumption would be a key for China.
Well, I'm just looking at some analysis from Bloomberg Economics here regards the November credit report out of the government, and it suggests that there's not a lot of private demand for credit in China right now. What are your observations?
Yeah, for China, definitely for private credit, we have seen that with the prolonged property downturn, that has given rise to demand for private credit to fund the distressed property developers that are undergoing restructuring. However, the economic slowdown has taken a hit on private credit in China in the last couple of years. While we have seen several new private credit funds being set up in China in the last couple of years, they are still in the phase of fundraising, which shows some continuous interest in China on private credit. These interests would be more into sectors like technology, new energy, as well as AI-related sectors.
Well, we heard from China's Vice Minister for Housing over the weekend. He was making some remarks about boosting demand, controlling supply of new land. I know that you see property presents an opportunity for private credit in China. What's your reasoning around this?
My reasoning was more on supporting the distressed property developers instead of more of the general property sector. Certainly, we are expecting maybe prices in China in terms of property would still need to, it's still finding its bottom. It's not stabilized yet. So we'll have to kind of continue to see how that would develop and whether or not your private credit investors would be more interested in more of the general property sector.
Do you see things perhaps getting more challenging in China once President Trump returns to the White House and we start having some rather vigorous conversations about trade?
Yeah, certainly. I mean, geopolitical tensions as well as how the tariffs would be applied on China. It's something that that would be affecting our growth forecast, as well as in terms of how interest rates would go, which would then also affect the exchange rate in China as well, right? We have done an analysis as to if the new administration really put on a 60% tariffs onto China. That could be generating, that would have an impact of 0.9 to 2.5% impact on the China growth forecast that we have, which currently we have 4.2% for next year.
Sally, there's a couple more markets I want to cover before we let you go. One of them is Japan. I know you see insurance companies becoming key investors there. What are you seeing?
Yeah, I mean, insurance companies have been quite interested in investing in private credit in Japan, given that they continue to look for yield. But at the same time, they have been reducing their equity investments on the back of an upcoming regulatory capital regime change that will be implementing in March 2026. Insurance companies have also been reducing their equity investments. So therefore, they are looking to redeploy some of the assets to a different asset class, which private credit can come into play.
And your thoughts on India as well? I mean, that's everybody's market darling right now. What sort of role do you see private credit playing in 2025?
Yeah, for India, private credit will continue to grow on the back of financing needs for sectors such as real estate, infrastructure, and manufacturing, as well as for companies that might not have been listed yet or in the growth phase. And also, private credit has been welcomed by many middle market companies as they have been providing, more flexibility in terms of structuring solutions that could be more tailor-made to the companies. The speed of the transaction is also favored, as well as the investors' ability to invest in riskier areas where the banks and the non-bank finance companies have been more cautious about because of higher credit risk.
We were speaking to Mary Nicola, our reporter, a moment ago about central banks. We are anticipating the Fed will ease once more this week, but the path ahead in 2025 is looking somewhat less certain. What are the risks of a higher for longer policy for private credit?
Yeah, I mean, with higher interest rates, that could be an impediment to the performance of some of the underlying assets under private credit. Primarily, for example, the leveraged buyouts portfolios of the business development companies in the U.S. But if interest rates would come down, that would be supportive of the valuation of the LBOs as well as some of the cash flow generation, and also would be supportive of the fundraising of private credit as investors would want to reach for more yield.
All right, Sally Yim, Managing Director and Co-Head of Global Banks Ratings at Moody's Ratings. Thank you so much for joining us. Well, key Chinese economic meetings this month have revealed that officials are planning to make stimulating demand and consumption their top priority in 2025. And that's going to be welcome news for luxury brands who have seen sales sliding and fortunes fading as shoppers tighten their belts. We've got more from our China correspondent, Min Lo.
This 5-story Louis Vuitton flagship store in Beijing was supposed to open its doors to shoppers in early 2024. LVMH CEO Bernard Arnault told Bloomberg he was optimistic about the group's growth in its largest market.
I am always optimistic, and the people have often concerns which are not materialized.
But now, sources say the store may not open until as late as next year. The slow progress is symbolic of the challenges European luxury brands face in China. LVMH shares have plummeted since the start of 2024, revealing the scale of the slump in demand from Chinese consumers. Another luxury group, Kering, warned that its annual profit will fall to the lowest level since 2016 due to weak Chinese demand for designer bags and clothes. Prestigious watch brands like Richemont, the group behind Vacheron Constantin and IWC, and Swatch Group, owner of Omega, are also affected. Swatch shares tumbled this year after sales in China, which account for about a third of its revenue, fell sharply.
Many watch manufacturers are really dependent on China, generating 40–50% of their sales.
This pullback in lavish spending is hitting some of the world's richest. LVMH CEO Bernard Arnault's fortune tumbled from the top spot in the Bloomberg Billionaires Index. Founder of Kering, François Pinault, fell out of the global 100 richest. Shoppers in the world's second largest economy are shying away from excess buying as Beijing grapples with low domestic consumption and a shaky property market. President Xi Jinping's government has rolled out a series of stimulus measures to boost sentiment. Bloomberg Intelligence says China's luxury goods sales and the downturn in the industry may reverse in the second half of 2025 if Beijing continues to roll out economic support. Min Lo, Bloomberg News, Hong Kong.
China correspondent Min Lo there. We have more in a moment. This is Bloomberg. Looking ahead to the top market themes for next year, and India still on the radar for investors thanks to some resilience in its domestic economy. Still, stock valuations are a concern amid slowing. For more on Indian markets, let's get to Asia stocks reporter John Cheng. So, John, what's the outlook for Indian equities, and why has this remained one of fund managers' top bets for 2025?
So as you mentioned, valuations are definitely a concern, but overall, during our conversations with fund managers, there's still overall quite bullish on Indian equities. And Of course, one of the biggest reasons is, the structural growth story in India is still very promising. The rapid urbanization and also, like the evolving economic structure is, inviting a lot of stock-picking opportunities. But, people just probably have to be a little bit more selective there. And if you look at the Nifty 50 index, after slumping into correction territory last month, it has rebounded pretty quickly, and the foreign outflows has somewhat eased already this month. So those are all very promising signs. And in terms of stock picking, people I spoke to are recommending large cap names in the financial, healthcare, and industrial sectors versus their small cap peers to really play that domestic growth story in India.
So how about the fixed income side? How are things looking there for India?
Of course, the RBI, as we all know, it has an easing bias now, and that is expected to continue into 2025, and that's definitely boding well for Indian bonds. And of course, one of the biggest tailwinds for Indian government bonds this year has been the inclusion in global bond indices, and that's expected to continue to drive inflows. And as we see potentially more easing from the RBI, that's boding well for bond prices as well. So that has remained one of the top bets for investors in 2025.
Well, we just had a bit of a mixed bag in terms of data out of China, and the problems there well publicised, but China's growth rate still one to be envied if you compare it with developed world peers. Is this still on investors' radar?
Definitely China, given it is being a heavyweight in the EM index, investors, it's hard for them to completely ignore China in their portfolios. But, the way to play China's rebound may be to be a bit more selective as well. Onshore equities versus offshore to really play that potential stimulus from Beijing, the consumer, and also the property sectors. And also a lot of people are pointing out to us that financial shares, especially banks, could be one of the safer bets on China, given, there are a lot of macro uncertainties looming in the market. We get potential tariff threats from Donald Trump and, soft patches in the economy. So the high dividend offered by that sector is looking very appealing to a lot of investors, especially as the PBOC is entering in easing mode. So, and there's definitely still a lot of opportunities within Chinese equities.
Yeah, Trump risks shaping up as one of the top bets of 2025. John, we've got about a minute left. What are some of the other top bets for next year?
Looking at ASEAN, I think Indonesia is emerging as a very interesting bet for a lot of investors as well. Similar to India, is a very domestically driven market. So, and that has presented an opportunity for investors, in terms of Indonesian government debt. And on the equity side, I think Indonesian banks are looking very attractive as well, given they have pretty attractive dividend yields, and the loan growth story is pretty solid in that market. And apart from Indonesia, we are seeing some opportunities in Vietnam as well. The growth trajectory is looking very solid, and also on the equities front, there's a high chance that it might be able to join the FTSE Emerging Market Index, so that will drive a lot of potential inflows as well.
All right, Asia Stocks reporter John Cheng there. We'll just leave you with a look at cryptocurrency. Yes, Bitcoin hitting a new record. Donald Trump confirming that there will be a Bitcoin reserve. Let's see what it looks like. Well, that is it for Insights. Horizons Middle East and Africa up next. This is Bloomberg.